The Indian stock market is a fascinating place. Think of it like a dense, vibrant jungle. It is teeming with life, full of hidden treasures, incredible opportunities for growth. Every day, fortunes are made, and sometimes lost. For many aspiring investors in India, this jungle feels both exciting and intimidating. You hear stories of people who planted a small seed of investment and watched it grow into a mighty tree. You also hear cautionary tales of those who got lost, taking a wrong turn and losing their way. The sheer number of companies listed on the Bombay Stock Exchange and the National Stock Exchange can feel overwhelming. It's a world of numbers, charts, and breaking news that moves at lightning speed. So, how do you navigate this complex jungle? How do you separate the promising saplings from the weak weeds? You wouldn't venture into a real jungle without a map and a compass, would you? Doing so would be reckless. Similarly, venturing into the stock market without the right tools is just gambling. You need a reliable guide, something to help you make sense of the chaos and point you in the right direction. This is where your journey to becoming a savvy investor truly begins. It starts not with a lucky guess or a hot tip from a friend, but with learning how to read the signs of the market for yourself. This guide is designed to be that map and compass for you. We are going to demystify the world of Indian stock market investing. We will equip you with the essential tools you need to not just survive, but to thrive. Imagine being able to look at a company like Reliance Industries or Tata Motors and understand its health beyond just the stock price. Imagine having the confidence to decide whether a stock is a good buy, a hold, or a sell, based on solid evidence rather than just gut feeling. This is not some secret knowledge reserved for the experts. It is a skill that anyone with the willingness to learn can acquire. By the end of this journey, the stock market jungle will feel less like a daunting maze and more like a land of manageable paths leading to potential wealth. You will learn to spot the opportunities, avoid the common pitfalls, and invest with a newfound sense of confidence and clarity. So, let's take our first step into this exciting world together. So, what are these magical tools we keep talking about? In the world of investing, these tools are called indicators. Simply put, stock market indicators are calculations. They are derived from a stock's price, trading volume, or a company's financial data. Think of them as the vital signs of a stock, much like a doctor uses a thermometer or a blood pressure monitor to check a patient's health. These indicators don't predict the future with 100% certainty. Nothing can. However, they provide crucial clues and insights into a stock's performance, its underlying value, and potential future direction. Instead of just looking at the current stock price, indicators give you a much deeper story. Let's take a simple analogy. Imagine you want to buy a used car. You wouldn't just look at the price tag, right? You would check the mileage, look under the hood at the engine's condition, check the service history, and maybe even take it for a test drive. Each of these checks is an indicator of the car's true value and reliability. Stock market indicators work in the exact same way. They help you look beyond the shiny exterior of a rising stock price to see the real engine of the business underneath. Now that we know what indicators are, it's important to understand that they generally fall into two main categories: fundamental analysis and technical analysis. Think of them as two different types of detectives trying to solve the same mystery. Which stock is a good investment? First, let's talk about fundamental analysis. This path is all about investigating the company itself to understand the core value of the business. On the other hand, we have technical analysis. This path focuses on the stock's price movements and trading volume. Smart investors often use both fundamental analysis to find a great company and then use technical analysis to find the perfect time to buy its stock. Let's dive deeper into the first path, fundamental analysis. As we touched upon earlier, this method is all about becoming a business detective. To answer these questions, a fundamental analyst pores over a company's financial documents. The three most important documents are the balance sheet, the income statement, and the cash flow statement. From these financial statements, we derive fundamental indicators. These are ratios and metrics that help us quickly assess a company's performance. For example, the price-to-earnings ratio, or PE ratio, tells us how much the market is willing to pay for each rupee of the company's earnings. The calculation is straightforward. Suppose TCS trades at 3,800 rupees per share. Its PE is 38. Suppose Infosys trades at 1,500 rupees. Its PE is 25. Based on this metric, Infosys looks relatively cheaper than TCS. But a lower PE doesn't automatically mean it's a better buy. To understand the PE ratio, we first need to understand its denominator, earnings per share, or EPS. Suppose Reliance reports a net profit of around 60,000 crores, and it has about 670 crore shares outstanding, which is approximately 89.5 rupees per share. What you really want as an investor is a company with a consistently growing EPS. For instance, HDFC Bank, you'll likely see a steady upward trend in EPS over the last decade. But how efficiently is it generating those profits? This is where our next indicator, return on equity or ROE, comes in. Suppose Hindustan Unilever Limited has a net profit of 10,000 crores and its total shareholders' equity is 50,000 crores. Its ROE would be 20%. Now, let's say a competitor, ITC Limited, has an ROE of 15%. This comparison suggests that HUL is more efficient. A consistently high ROE is a sign of a great business. Companies like Asian Paints or Pidilite Industries have historically maintained very high ROE figures. Our final fundamental indicator tackles a crucial aspect of business risk, the debt-to-equity, or DE, ratio. Imagine a company like Bharti Airtel. If its total debt is 1,60,000 crores and its shareholders' equity is 80,000 crores, its DE ratio would be 2. This is considered a high level of leverage. For most other businesses, a high DE ratio is a red flag. As a prudent investor, you should generally be wary of companies with a DE ratio greater than 1. Many of India's top software companies like TCS and Infosys are famous for having very low or zero debt. When you find a company that has a high ROE and a low DE ratio, you may have just found a fundamentally powerful investment. Welcome to the world of technical analysis. We're now shifting our focus from the company's financial statements to the stock chart itself. We'll explore 4 of the most essential technical indicators: moving averages, the relative strength index, the MACD, and the all-important volume. Let's begin with the moving average, or MA. Its primary job is to smooth out the day-to-day price fluctuations, allowing you to see the underlying trend more clearly. A golden cross, a classic bullish signal. A death cross, a major bearish signal. MAs can also act as dynamic support and resistance. For example, Asian Paints in a long-term uptrend dips to its 200-day MA. A long-term investor might add to their position. Our next indicator, the Relative Strength Index, or RSI, tells us about the momentum, the speed and the strength of price changes. When the RSI line goes above 70, it suggests that the stock is becoming overbought. Conversely, when the RSI line drops below 30, it indicates that the stock may be oversold. Another powerful signal to watch for is divergence. A bullish divergence occurs when the stock price makes a new low, but the RSI makes a higher low. Now, let's look at an indicator that cleverly combines both trend and momentum into one: the Moving Average Convergence Divergence, or MACD. When the MACD line crosses above the signal line, it is a bullish signal. Conversely, when the MACD line crosses below the signal line, it is a bearish signal. The histogram provides a great visual confirmation. When the histogram bars are above the zero line and growing, bullish momentum is strong. Our final technical indicator is perhaps the most underrated: volume. Volume tells you how much conviction is behind the move. A price move with high volume is significant. When a stock breaks out above resistance, you want to see a huge volume spike. Conversely, a rise on very low volume should make you skeptical. Low participation often means a fake out or a weak rally. So we've now explored the two major schools of thought. The big question is, which ones should I use and when? A long-term investor will lean more heavily on fundamental analysis. Your decision to buy is driven by the business, not the chart's squiggly lines. A short-term trader will rely almost exclusively on technical analysis. Your decision is driven entirely by price action and momentum. The most powerful signals come from a concept called confluence. Confluence is when multiple independent indicators all point to the same conclusion. Let's build a practical example. SBI pulled back to its 200-day moving average. RSI has dropped to the oversold territory. MACD, a bullish divergence. Finally, you wait for the price to confirm. A large bullish candle form, accompanied by a significant spike in volume. This is your fourth and final confirmation. This confluence of four distinct signals gives you a very high probability entry point. You have built a solid, evidence-based case for your investment or trade. We have come a long way on this journey together. We uncovered two paths: fundamental analysis, technical analysis. We delved into the business detective's toolkit. We became market psychologists and learned to read the charts. You are no longer just looking at a stock's price. You analyze its value, its health, its trend. You've transformed from a passive observer into an informed analyst. However, with great knowledge comes great responsibility. The first rule of responsible investing is to always manage your risk. The second pillar of responsibility is to commit to continuous learning. The most successful investors remain lifelong students, curious and humble. Patience is perhaps the most underrated virtue in investing. The stock market rewards those who can wait. Finally, you must be the master of your own emotions. The two biggest enemies of an investor are fear and greed. The knowledge you have gained holds a special significance for us here in India. Our nation is on a remarkable growth trajectory. You have the skills to become a self-reliant investor, an Atmanirbhar investor, building a crucial life skill that can help you achieve your financial goals, all while being a part of India's incredible growth story. The path from learning to earning is paved with practice. Start by paper trading, making mock trades to test your strategies. Remember that building wealth in the stock market is a marathon, not a sprint. The knowledge you now possess is your anchor in the stormy seas of the market. The jungle of the stock market is a land of opportunity, and you now hold the map. Go forth, invest wisely, and may your journey be a prosperous one.